Hi students, welcome back to Appleby Academy's classes. So in this video, we are going to discuss about accounting principle. So we know that it's a very basic area of accounting and auditing module. And when you're just going through this accounting principle, you can see the questions from this particular area for most of the time. Okay, so firstly, we'll just go through the question which got asked for the recent exam, that is for NTA NET December 2021, June 2022. That was on 29th. Which was on September, shift 1. Okay, see the question. A company does not include the value of skills gained by its employees from training programs in its annual financial statement. Which one of the following accounting concepts is being applied in this case? So here we have a situation and we need to identify which is the accounting concept which makes this particular item should not be included in the books of accounts. Okay, and we have the options: going concern concept, money measurement concept, revenue recognition concept, and business entity concept. So all these concepts are very important. And see, this is a very basic area and we should have a better idea regards to this accounting principles and all. So what is this accounting principle, or what's the purpose of this accounting principle? So we'll say that generally accepted accounting principle, that is GAAP. So this actually provides a guidelines that how a particular transaction to be recorded in the books of accounts. Okay, how you should treat a particular item. So generally it is giving you the way how you need to prepare your books of accounts, or how you need to treat various items in the books of accounts. Okay, so it refers to the rules or guidelines adopted for recording and reporting of business transaction in order to bring uniformity in preparation and presentation of financial statement. And why there is such a guideline, or why there is such a principle? It is to bring a uniformity among the financial statement of various business or various enterprises. Okay, so that we can make a better comparison, or we can have a better analysis like a way. Okay, so when you're just discussing about this accounting principle, mainly we are classifying this accounting principle into two categories, which is accounting concepts and accounting convention. So you should be very conscious about this particular classification, because maybe they can just ask you about which of the following, or do identify the accounting conventions from the following. So maybe we know all these accounting principles, but while studying we not make such a differentiation between accounting concepts and convention. So if such a question got asked, it will be confusing. So see, there is only 4 accounting conventions and remaining all are accounting concepts. So such a classification should be there. Okay, so when it comes to accounting concepts, we have separate entity concept, money measurement concept, going concern concept, dual aspect concept, realization concept, cost concept, accounting period concept, matching concept. An accounting convention includes conservatism, consistency, full disclosure, materiality. So there are only 4 accounting conventions, and all the other remaining principles are accounting concepts. Okay, so anyway, our question was based on accounting concepts. So we will discuss about accounting concepts in detail. So what do you mean by this accounting concept? See, it is basically the fundamental idea or the assumptions which we are actually using while we are recording a particular transaction. Okay, so we have certain assumptions. So based on that assumption, we are just making, or we are just preparing our financial statement. So these assumptions are depicted by this accounting principle, which give or which guide you how you need to record your transaction, or how you need to treat a particular item. Okay, so now we will discuss about the basic or important accounting concepts which got asked for the question, as from the question. So the first one is business entity, a very important, very basic concept. What is business entity concept? So we know that there is a separate legal entity for the business from its owner. Okay, so that is both these parties, or while treating or while preparing financial statement, we consider the owner of the business and the business as separate persons. Okay, that's why we know that while we are preparing the financial statement, we know that we are actually recording capital. Okay, we are actually recording capital in the liability column. Why? See, capital is the amount which is contributed by the owner of that particular business. So here we are just treating it as a liability, because here we are considering that this owner is a separate person and the business have the responsibility, or the business has the liability to pay back this amount to the owner. That's why we are recording this particular item under the head of liability in balance sheet. Okay, this is actually based on this particular concept. So next time they can ask, okay, so we are recording capital under the liability head of balance sheet. This is based on which concept of accounting? Okay, that is actually based on business entity concept. So the concepts assume that the business has a distinct and separate entity from its owner. So when a person brings money as capital into his business, it is treated as a liability of the business to the owner. That's the best example which you can actually use to express this particular concept. Okay, so that's about business entity concept. That means there is a separate legal entity between the owner and the business. Both these are separate persons, right? important concept, which is money measurement concept. So the name itself says that what does it is? That is, it's saying about some measurement. That means according to this particular concept, we should record only those transactions or events which can be measured in monetary terms. Okay, like the way that you should be able to identify the monetary value. Such an item should only find a place in books of accounts. Okay, let's see only those transaction happenings in an organization which can be expressed in terms of money are to be recorded. So if you're not able to express a particular item in monetary terms, then it do not find a place in books of accounts. So that's the best example here. If in our organization we have we have an employee who is such a creative person, or his capability is very high, still we are not able to make we can't measure his creativity, or we can't measure his capability in terms of monetary value. So like a way that we are not actually recording his creativity or capability in the books of accounts. Okay, so simply, if you're not able to measure a particular activity in monetary terms, you will not find a place in books of accounts. And if you're able to have a monetary value, or if you're able to ascertain a monetary value for a particular event or transaction, you can directly record it to the books of accounts. Okay, so that's a second important concept. Moving to the next concept, which is going concern concept. Another important concept which is related to accounting principle. So this particular principle says that, which is about the life of that particular business. So according to this concept, it is considered as the life of the particular business is indefinite. So I mean infinite, okay, because we can't say that, or we will say that this particular business is going to run it is going to function for a long period. Okay, so we are saying that it is not going to it is not going to liquidate in your future. It will continue and continue and continue. Okay, so a business firm would continue to carry out its operation indefinitely for a long period of time and would not be liquidated in the foreseeable future. So here it is assuming that this particular business will function for a long period. Okay, like a way that we are also planning certain things. Why we are planning? We will plan that, okay, we will do a particular thing after 5 years or after 4 years. Here we are thinking that, okay, we will be there for these much years. Like a way that a business is also thinking the same concept, which is referred as going concern concept. And let's see the examples. The best example you can actually put forward for this going concern concept is prepaid expense. What do you mean by this prepaid expense? Here we are paying the expense before it is becoming due. For example, if the building which took for the purpose of the production or whatever, something which is related to that business, is actually for rent. Okay, so you're just paying an advance, or you are making an advance payment for the rent for the coming 2 years or for coming 12 months. Okay, so here you made an advanced payment. Okay, that is your expense. So we will consider it as prepaid expense. Okay, you paid earlier. Okay, so here why we are making such an expense, or why we are making such an advance payment? Here we know that we will be there for this much period. Okay, so we are assuming that you will be there for such a future period. Okay, so you can see that this is an applicational example which is related to going concern concept, prepaid expenses. Okay, so this is a fundamental accounting concept behind the treatment of depreciation also. In case of depreciation also, see what we are doing here also, we are actually calculating the depreciation based on the life period of that particular asset. Okay, so we know that if the life period of a particular asset is for 10 years, so we are just assuming that it will be there for 10 years, that will be working for these 10 years. Based on that, we are actually calculating the depreciation. We know that by calculating the depreciation, we are taking the values of that particular asset and life of that particular asset in order to calculate depreciation. So here also it is based on the life of that particular asset. So these two are important examples which you can connect with going concern concept. Okay, and now we are moving on to the last one, which is revenue recognition concept. So it is also known as realization concept. What do you mean by this revenue recognition or realization concept? See, this particular concept says that you need to record a particular transaction whenever you know, or whenever you just identify that particular transaction, not the period that when you are just getting money from that particular transaction. Okay, let's say once more, revenue for a business transaction should be included in the accounting records only when it is realized. That means you are realizing that you will get amount for this particular transaction, or you just realized a particular sales, you should record it in your books of accounts. Okay, so in order to become, or in order to have much more clarity, we'll just take an example. Credit sales are treated as revenue on the day of sales are made, and not when the money received from the buyer. So here you can see that there is a credit sale. Credit sale means we know that we are not actually collecting the amount in that particular date. We are just receiving that amount on a future date, right? So here, when this credit sale is happening, we are actually recording that particular transaction in the books of accounts. Okay, at the day when credit sale happened. Okay, not the day when you are just receiving. So let's take if a credit sale happened on March 15th. Okay, on March 15th, a credit sale happened and you are going to receive the amount on April 21st. Okay, so there is a gap between the day when sales made and the day when you are going to collect the amount from the customer. So there is a gap. So here we will record credit sale. Whenever there is a credit sale, you will record in that particular day. So in that day, that means on March 15th itself, you will record there is a credit sale. Okay, not the day when you are going to receive the amount. When a sale happened, we will record on that day itself. Okay, so because we know that we will be receiving the amount for the same and the future day. Right. So when you are just realizing or when you are just identifying, you will receive a particular payment, you should record it in the books of accounts. Okay. So when you are realizing, when you know about that, you should record it. Okay. That's about revenue recognition or realization concept. Now we are going to discuss this particular question. A company does not include the value of skills gained by its employees from training program in its annual financial statement. So here you can see that employee got a trained program and based on that we know that his skills will be enhanced, and the value of this skill is not actually considered while you are preparing financial statement. What will be the reason? What will be the reason? So we know that value of skill or a skill of a particular person is not able to monetize. We are not able to measure it in monetary value. That's why we are not recording it in the books of accounts. So it is not at all based on going concern concept. It is just based on money measurement concept. Revenue recognition is different concept. Business entity is also different concept. So the correct answer for this question is option B, money measurement concept. So you can see that this is a very basic question or very simple question which you can easily answer if you know about the various concepts very well. Okay, so anyway, in this video, we discussed about 4 important accounting concepts. See, all accounting concepts or all accounting conventions are very, very important. You should have a proper idea about all these things and you should also go through some of the examples related to these accounting principles. Okay, so I hope this video will help you for your preparation. Thank you and happy learning.